In this video, traders, we're going to look at the 3-day pause trading strategy, a really good one for getting on the end of markets that you think you've missed. Stay tuned. Hey traders, a very warm welcome to you. Okay, so digging into some of the old textbooks that I've got, looking at some of the old strategies they used many years ago and see if we can pick some good ones that are relevant in today's market action. And in today's market action, how often have you seen a market that's ripped off the upside or ripped off the downside and thought, I want to get long, I want to get short, how do I time it? We've done other videos on that. We talked about buying pullbacks, we talked about this, talked about that. This one is specific rules for getting on board a market that is a trending market and you want to get on board it. It's specific rules for doing just that. Right. 3-day pause trading strategy. It's called that because we're waiting for 3 days. The rules are here. I'll go through them in a second, but I just want to clarify this is for swing traders. This is swing trading strategy. You can use it on any market. It's going to be better. We'll see in a minute what it's actually better on, but it's going to be probably fine for stocks, indices, currency pairs, commodities, cryptos, anything like that. I would say it's pretty broad. Okay, so let's look at the rules and let's look at why it works and what it's all about. So the rules are we need to have a trending market condition. So an easy way of filtering that, if we're doing specific rules, is using an ADX, and we have that as above 30. So we use an ADX reading above 30 and the DMI, which is often goes hand in hand with ADX. I know if you're using TradingView or something like that, you're going to be able to see them all in one field, in one section. They're going to put it all in one go for you. The DMI positive has got to be above the DMI negative. The directional movement has got to be above the negative line. That's just another way of kind of framing the trend. You could probably do it without that. You could probably do it with just an ADX because we just want to see something that has a decent trend. If you don't have ADX, you don't like ADX, possibly you could use it with an RSI being overbought for a long period of time. Possibly you could use something like a distance away from moving average. You know the score, guys. Anything like that that signifies a trend. But ADX is not a bad one to use. Okay, there's your filter. Number two, you've got to now see 3 days of lower lows. So this chart here, if you can imagine this, we've had a run up, nice big run up, assuming we have all these filters tick, the ADX, the DMI. Now we have day one is this bar here, day two is this bar here, if you can see that, and day three is that bar there. So we've got nice little run up now waiting for these 3 bars or 3 candles, whatever we're trying to do. We're looking for lower lows. So pretty much lower lows are day one, we've got lower than the prior day. Day two, we have lower than that prior day. And day three, we have lower than the prior day before. We can't, I think most of us get that, but it's just that little lower low, lower low. So a little bit of supply demand shift over 3-day period. Okay, have that 3 days lower lows. Now on day four, we want to buy above the day 3 high. So assume this is day 4 here, come in, the open comes, ding, off we go. It doesn't really matter where the low goes of the day, but we're looking to buy above the high. Now, I've used plus 10 ticks, but you're going to have to adjust that for the volatilities of the market you're trading. 10 ticks, 50 pips, whatever it may be. Maybe you could use something like an average true range to give you that. The point is you want to buy above the high plus a little bit. So just plus a little bit, not too much that you're too far ahead, but just plus a tiny bit, not so small that it might just fake you out. Don't have it so tight. Maybe 10 ticks might be too tight depending on what you're trading, but you know, use a bit of common sense for that one. So it's just above that high. So there's our buy here. I'm going to put there's our long. We're going long right there. Okay, so the day 4 as it breaks above that day 3 high, and a stop very easy. It's going to be below that day 3 low. Now, obviously, if that actually happened now, we went long and then it came back below, we'd be stopped out. But assuming it did that in the morning and the afternoon it rallied, then you just bring the stop under the prior day's low. So there's your sell stop there, and you add a few ticks as well. I mean, I've said here 20 ticks. You can make it 10 ticks. You can make it, just adjust it. The point is, if it's a genuine momentum change, turn of momentum trade, which is what this is, it's a big momentum move, a little bit of a pause, and then we're just using a very strict criteria to get on board the pullback. We talked other ways of doing it. This is one way of doing it. And the good thing about this one is it can go deep. These can be 3 really pretty deep days, and then you take it on day 4, and all you're doing is waiting for that momentum to turn again, buying above that prior day's high, dragging your stop up below the prior day's low. And something to add with this, guys, is you want to trail. This is the sort of thing that you don't want to be trying to shoot ridiculously for, because this may well retest the highs, come back, do a deeper pullback. So you want to kind of trail up. In a perfect world, perfect scenario, should I say, this is what's going to happen. It's going to continue on. It's going to have that little pause, and then you're going to be very, very well placed to capture that second leg of the trend. Now, one thing not in these rules, but I'd like to add to it, is if this has pulled back more than 3 times, don't take it. That's just from my personal experience. I know that 3 pullbacks, not to say the trend can't carry on for far more, that does happen, okay? And you're gonna have to eyeball the chart and see. But generally, if you've had 3 kind of shallow pullbacks, when you're going to your 4th and 5th pullback, the odds slightly go against you. That's not to say you're not going to get it right, but I prefer a first or second time this does it after a good ADX, strong trending move. Get those pullbacks, get on board it, tighten your stop up, drag it up, and then see how far you can get it. So those are the rules for you guys. Your ADX is just like a trending filter. 3 days of lower lows after your trend. Day 4, you're buying as you break above the high, so that you're making sure you're not kind of getting involved if it does keep going lower. And then you're dragging your stop up to below that prior day's low. So if it breaks that, it does a fake out, you're out, and you've not done too much damage. Risk reward ratio is going to be quite high on this one. So let me know your thoughts in the comment section below. Let me know if you try this one out, how you get on with it, or if you've been using something similar. Be interested to know your guys' comments. Okay, thumbs up if you like this kind of stuff. Much appreciated. See you in the next one. Take care. Good trading. Bye-bye.